Investing in the stock market can be a very rewarding journey towards financial growth. A smart and focused approach is always a good place to start. In this video, we will explore some of the best investment strategies beginner investors can pursue to win in the stock market. Welcome to Acme Digital, the #1 channel to help you improve your financial literacy. Here we provide contemporary financial information and practical ideas that you can implement in your business or personal finance to be on your way to financial freedom. Here are some excellent investment strategies tailored for novice investors. 1. Embrace a long-term investing perspective. Focus on buying quality stocks of companies with strong fundamentals and sustainable business models. Aim for growth and dividend-paying stocks that have a history of consistent performance and avoid timing the market. Instead, focus on holding stocks for several years to benefit from compounding returns. Study the company's financials, industry trends, and evaluating its overall value in the market. This strategy allows novice investors to assess a stock's intrinsic worth and make investments based on its potential for growth. 2. Utilize the dollar cost averaging strategy. Invest a fixed amount of money regularly, regardless of market fluctuations. This approach helps in buying more shares when prices are low and fewer shares when prices are high, ultimately reducing the impact of market volatility. Dollar cost averaging, DCA, focuses on consistency in investing rather than attempting to time the market or predict price fluctuations. Here's how dollar cost averaging works. An investor commits to investing a fixed amount of money at regular intervals, such as monthly or quarterly, regardless of whether the market is up or down. With each investment period, the fixed amount buys more shares when prices are low and fewer shares when prices are high. This way, the investor buys into the investment at different price points over time. DCA helps to reduce the risk of making a significant investment at an inopportune time by spreading purchases across different market conditions. It helps average out the cost per share over time. During market downturns, more shares are bought for the fixed amount, potentially lowering the average cost per share in the portfolio. Dollar cost averaging is often seen as a disciplined approach to investing that removes the pressure of trying to time the market and focuses on consistency and long-term wealth accumulation. It can be applied to various investments, including stocks, mutual funds, or exchange-traded funds, ETFs. 3. Value investing approach. Value investing is an investment strategy pioneered by Benjamin Graham and popularized by Warren Buffett. It involves identifying undervalued stocks trading at prices lower than their intrinsic value, providing an opportunity for potential capital appreciation. Key principles of value investing focuses on determining the true or intrinsic value of a stock by analyzing its fundamentals, including earnings, assets, and cash flow. Emphasizes purchasing stocks at a significant discount to their intrinsic value to cushion against market fluctuations or errors in valuation. Long-term perspective typically involves a long-term holding period, allowing the market to recognize and reflect the stock's true value over time. Approach to value investing. Fundamental analysis. Scrutinize financial statements, earnings reports, balance sheets, and cash flow statements to assess the company's financial health and performance. Price to earnings, P/E ratio. Consider stocks with lower P/E ratios compared to industry averages, indicating potentially undervalued stocks. Asset-based valuation. Assess the value of a company based on its tangible assets, such as real estate, equipment, or inventory. Dividend yield. Favor companies that pay dividends and have a history of consistent or growing dividend payments. Contrarian approach. Be willing to go against market trends and sentiments, seeking opportunities where others may overlook undervalued stocks due to short-term fluctuations. Advantages of value investing. Potential for long-term growth. Investing in undervalued stocks can lead to substantial returns when the market corrects to reflect their true value. Lower risk. By focusing on companies with strong fundamentals and purchasing at a discount, value investors aim to reduce downside risk. Less emphasis on market fluctuations. Value investors prioritize company fundamentals over short-term market movements, fostering a more patient and disciplined approach. Patience required. It may take time for the market to recognize the true value of a stock, requiring patience from investors. Risk of value traps. Not all undervalued stocks will realize their intrinsic value. Some may remain undervalued or deteriorate further. Value investing demands thorough research, a keen eye for undervalued opportunities, and the discipline to adhere to a long-term investment horizon. While it doesn't guarantee immediate success, it remains a favored strategy among many successful investors seeking opportunities in the stock market. 4. Growth investing. Growth investing stands as a compelling strategy for those eyeing long-term wealth accumulation through stocks. Rooted in identifying companies with high growth potential, this approach revolves around investing in companies poised for rapid expansion revenue surges, and market dominance. Key principles of growth investing: focus on future potential, emphasizes identifying companies with the potential for substantial growth in revenue, earnings, or market share. Forward-looking approach prioritizes future growth prospects over current value, often leading investors to favor companies trading at higher valuations relative to earnings. Innovation and market disruption targets companies driving innovation, disrupting industries, and capturing emerging market trends. Approach to growth investing: evaluating growth potential, analyze company prospects for expansion, examining revenue growth rates, market opportunities, and the scalability of their business model. Embracing disruptive innovation: seek companies at the forefront of technological advancements or disruptive innovations likely to revolutionize industries. Quality management: assess the leadership and management team's ability to execute growth strategies and adapt to market changes. Indicators for growth investors: revenue and earnings growth. Focus on companies demonstrating consistent and accelerating revenue and earnings growth. High price to earnings (P/E) ratios: acceptance of higher valuations relative to current earnings, anticipating future growth prospects. Technological advancements: favor companies driving technological innovation and poised to lead in rapidly evolving markets. Advantages of growth investing: potential for high returns. Successful growth companies can yield substantial returns over the long term as their value appreciates. Riding market trends: positions investors to capitalize on emerging market trends, technological advancements, and shifts in consumer behavior. Resilience in market downturns: some growth companies demonstrate resilience during market downturns due to strong business models and market positions. Challenges: valuation risks: high valuations can lead to increased risk if growth expectations are not met, potentially resulting in significant price corrections. Volatility: growth stocks can experience higher volatility due to market sentiment shifts and rapid price movements. Growth investing embodies the pursuit of future potential, innovation, and market disruption. While it involves higher risk due to valuation uncertainties and market fluctuations, its potential for substantial returns attracts investors seeking opportunities in dynamic, high-growth companies. As with any investment strategy, diligence, research, and a long-term perspective remain crucial for success in growth investing. 5. Index fund investing. In the world of investment, index funds have emerged as a compelling option for both novice and seasoned investors, offering simplicity, diversification, and often lower costs. These funds have gained widespread popularity. Let's explore the essence of index fund investing and why it's considered a cornerstone of many portfolios. Index funds are mutual funds or exchange-traded funds, ETFs, designed to mirror the performance of a specific market index, such as the S&P 500, NASDAQ Composite, or Dow Jones Industrial Average. They operate on a passive investment approach, aiming to replicate the performance of an index rather than beat it. This strategy often leads to lower management fees compared to actively managed funds. Key principles of index fund investing: diversification: index funds offer broad exposure to a market index, spreading risk across multiple companies and sectors. Low costs: due to their passive nature, index funds typically have lower expense ratios compared to actively managed funds, saving investors on fees. Market performance: investors in index funds aim to match the overall performance of the market index the fund tracks, rather than outperform it. Benefits of index fund investing: 1. Provides instant diversification across numerous stocks or assets within the index, reducing individual stock risk. 2. Typically boasts lower expense ratios compared to actively managed funds, allowing investors to retain more of their returns. 3. Tends to perform in line with the market, avoiding the volatility and risk associated with attempting to beat the market. 4. Offers simplicity and accessibility to both new and seasoned investors, requiring minimal ongoing management. Strategies for index fund investing: use index funds to create a diversified portfolio across various asset classes, such as stocks, bonds, and international markets. Invest systematically over time, benefiting from the power of compounding returns. Periodically review and rebalance your portfolio to maintain the desired asset allocation. Index fund investing offers a straightforward, cost-effective way to gain exposure to broad market indices, making it an attractive choice for many investors. By providing diversification, lower costs, and a long-term investment approach, index funds serve as a solid foundation for building a well-diversified and stable investment portfolio. 6. Income investing. Income investing enables you to build wealth through regular returns. It aims to generate a steady stream of income through investments in dividend-paying stocks, bonds, or real estate investment trusts. It can be a great option for those looking for a regular income source. Income investing stands as a robust strategy aimed at generating consistent returns from investments while prioritizing income over capital appreciation. This approach caters to investors seeking regular cash flow and stable returns, often achieved through dividends, interest payments, or other income-generating assets. Let's delve into the essence of income investing and its core principles. Income investing prioritizes regular income generation from investments rather than relying solely on potential price appreciation. Investments include dividend-paying stocks, bonds, real estate investment trusts, REITs, high-yield bonds, and dividend-focused mutual funds or exchange-traded funds, ETFs. Key principles of income investing. Stable cash flow emphasizes investments with a history of stable and predictable income streams, such as dividend-paying stocks or bonds with regular interest payments. Dividend yield looks for investments offering attractive dividend yields or interest rates relative to their price, providing a steady stream of income. Diversification spreads investments across various income-generating assets to minimize risk and create a well-balanced portfolio. Strategies for income investing focuses on established companies with a track record of consistent dividend payments and potential for dividend growth. Considers investment-grade bonds or bond funds, aiming for regular interest payments and lower risk compared to equities. Includes REITs, which provide income through dividends generated from rental income or property appreciation. Benefits of income investing. Steady cash flow offers regular income streams, providing stability and financial security for investors, especially during market downturns. Lower volatility typically exhibits lower volatility compared to growth-oriented investments, as the focus is on consistent income rather than market fluctuations. Risk mitigation. Diversification across income-generating assets helps mitigate risk by spreading exposure across different sectors and asset classes. Risks and considerations. Interest rate risk. Bond prices can fluctuate inversely with interest rate changes, affecting bond values and potential income. Market fluctuations. Economic changes and market conditions can impact dividend payouts or income streams from certain investments. Income investing appeals to investors seeking a steady stream of income while aiming for wealth accumulation. By focusing on investments providing regular dividends, interest payments, or rental income, investors can create a balanced portfolio that generates consistent returns. While income investing offers stability, it's essential to consider risk factors and maintain a diversified approach to build a resilient income-generating investment portfolio. Investing in stocks as a beginner requires patience, research, and a disciplined approach. By starting with education, adopting a long-term perspective, diversifying, and staying informed, beginners can set the foundation for a successful investment journey. Remember, the key is to develop a strategy aligned with your risk tolerance, financial goals, and commitment to long-term wealth accumulation. Steer clear of emotional decisions. Do not let fear or greed drive your investment choices. Avoid making impulsive decisions based on short-term market movements or stock price fluctuations. Regularly review your portfolio, monitor the performance of your investments, and make adjustments if needed. Stay informed about market trends and economic developments affecting your investments.